Hi everyone, a very good evening and a very warm welcome to all of you on yet another very relevant, interesting, and I would perhaps even add topical to this Edelweiss Connect classroom session on 5 investment options to build a passive investment portfolio. I'm sure a lot of us would have got perhaps a bit worried, or maybe I would use the word hassled, looking at the increased, enhanced volatility that we have been recently witnessing with regards to what's happening in the markets. At the same time, the recent fluctuations or the rise in interest rates would also somewhere be adding to my uncertainty in terms of how are my investments performing, and at the same time further aggravating my level of stress. And because of this, I would perhaps be wondering if there are any investment options which can help me have some kind of control over what happens to my investments when we come to situations like these with enhanced volatility, or even interest rate fluctuations. Adding passive investment options which are available under the mutual fund umbrella to your portfolio may provide you with the answer to this current situation or problem, whatever you want to call it. This is going to be my agenda that I would pursue to cover in the next about 30, 35, 40 odd minutes. We'll start with what actively managed funds are, and this is where in all probability a majority of our investments is, and hence starting with that I think would make a lot of sense. We'll then move to passive investing and understand what this passive investing is. We'll look at some key differentiators between the active versus passive investing. Post that, we'll finally move towards the crux of our discussion, which is where I shall provide you with 5 options between the equity investment schemes and fixed income investment schemes, uh, wherein you have passive options available to invest into. We'll round this off by sharing some benefits of investing into the passive investing options. So that's going to be my agenda. As usual, if there are any queries or questions, you can put it in the chat and I would respond to them towards the end of our discussion today. Moving on to one more way, or one way of categorizing mutual funds is to split them into actively managed funds and passively managed schemes. Okay, both are available for investments across the various asset management companies, and actively managed schemes have perhaps been a little more preferred than its passive counterparts, primarily because for reasons which I would be elaborating in the next few slides. But what is also important to note is that the passive investment options are also gaining higher interest from investors, and perhaps even, or even, and not perhaps, even higher allocation. Thereby, in the recent past, finding a much larger acceptance. What could be the reasons for this is also something which I would be discussing during the course of our discussion today. Let us begin with active funds. As the name suggests, it's an actively managed fund. The aim of active funds is to generate higher than the benchmark that it is being adjudged with, uh, getting returns higher than that benchmark. So for example, suppose you invest in, let's say, an XYZ large cap fund. The benchmark of this, let's say, XYZ large cap fund, for our example, is Nifty 50. Then the endeavor of this XYZ large cap fund would be to give you returns higher than those generated by the stocks listed in Nifty 50. So if Nifty 50 gives you a return of 10%, the aim of this actively managed XYZ large cap fund will be to give you returns which are in excess of 10%. It could be 10.5, it could be 11, it could be 12, whatever, but that is the endeavor of any actively managed scheme. In India, specifically alpha generation, or the endeavor to get better returns from the benchmark is something which is, as an it's an acceptance, or it's an expectation from most investors. And perhaps that's the reason why we have a lot of traction in these actively managed funds in terms of the investor interest. So the fund manager in these actively managed funds actually looks at the universe which is there in the benchmark, and actively picks up on securities which he or she would think are going to perform better, and hence that extra return over the benchmark. That's the idea of an actively managed fund. Okay, so as I was saying, the pros is obviously alpha generating. It is actively managed. Securities are bought and sold with the endeavor that they will perform better than the index that it is marked upon, and that's one reason why would prefer to have an active fund. In terms of cons, it is actively seeking to buy and sell securities, and because there is an active management or choice being made in terms of the security that would be chosen, it may sometimes also be a little risky, as you may be in a situation where I bought a particular security thinking that it would perform in a certain way, but that did not happen, because of which perhaps the risk element in actively managed funds go high. And at the same time, because there's a constant buying and selling, constant traction in terms of what a fund manager would be doing in terms of security selection, the operating expense and the cost of actively managed funds is a little higher than the passively managed funds. So that's the pros and cons. Then there is passive investing. Passive investing, as the name suggests, it's passive, meaning, buying and selling is not pursued very actively and regularly. The fund management team actually deploys something that is called as a buy and hold strategy to manage these passive funds. Meaning, the idea over here is to build a portfolio where you're holding the securities for a long period of time. The idea of any passive investment fund is to give returns similar to the benchmark. The fund management team, the fund manager and the research team that is there, which is in the fund management team, aims at replicating the returns and thus provides similar returns to the benchmark that is being replicated. Okay, so that's the idea. Over here, it's not about security selection. It's about selecting the entire index as it is and replicate it. And because of that, what happens is when your returns get linked to the performance of that index in totality. So it's a replication. World over, passive investing is actually more preferred by investors, and investors actually deploy more of their money in passively managed funds. That is primarily because world over, what's also been established is continuously and consistently being able to beat benchmarks and provide returns over the benchmark is something which is extremely difficult and perhaps even not feasible. So as an investor, if I think that beating benchmarks is something which may not be consistent, what will I do? I would choose the next best option, which is invest into schemes which would give me returns at least as much as the benchmark. And that is where investing in passive funds globally is something which has found a much larger acceptance and a much larger traction in comparison to the active funds. As I was saying, passive investment managers generally believe that consistently and regularly outthinking the market and choosing securities which may outperform the index may not really be possible, or they will not be able to be consistent with it. And hence these fund management teams actually look at replicating or creating a well diversified index through which they generate returns similar to that index. So that's the endeavor of passive fund managers. To sum this up, if I would look at the pros and cons of this, passive investing deploys something which is known as a buy and hold strategy, wherein there is no active regular selection of securities that they would want to trade into, making the overall operating cost come down, and thus making these cheaper in comparison to its active counterparts. The con, as per a lot of people in passive investing, is that it cannot beat the benchmark, which definitely it will never, because it is replicating that benchmark. And that perhaps is one reason or one con which a lot of investors point out, that I am only going to get returns which is similar to the benchmark. But looking at how markets are unpredictable, I think these may not actually be a total con. It may be something which will give certain cushions and certain predictability in terms of how my investments are performing. So that's about the pros and cons. To sum up between active and passive, active is something which is a hands-on approach. It is somewhere where the fund management team actively selects securities and decides on what they want to buy and sell. Passive investing is something which is more of a buy and hold. You buy the entire index and you hold on to those investments over a period of time and replicate the index. In terms of tax efficiency, active funds can, in certain years have a higher capital gains in a certain year, which would probably have its impact on the tax that you're paying. Passive funds, because of its buy and hold, typically do not have a massive capital gain in any year and are more consistent and spread out. Active fund managers can choose their securities basis what they think will perform. In that sense, passive fund management is a little limited because it's specific to an index wherein I would be replicating that index. And hence, there is no question of me being flexible. It is a fixed It is a fixed basket which I am replicating into. In terms of fees, we spoke in active because there's an active selection and active buying and selling. The operating cost and fees of active funds is higher in comparison to the passive investing options. Let us now look at the investing options available in the passive investment world when it comes to equity, on the equity side and on the fixed income side. Let us begin with looking at our equity side first. When we talk of investment options or passive investment options on the equities, on the equity side of things, or in equity schemes of the mutual fund under the mutual fund umbrella, the first option that I would like to share with you is called index funds. It's perhaps the easiest option available in passive equity schemes, index funds. Okay, as the name suggests, it is a portfolio of stocks designed to replicate the composition and performance of a financial market index. An equity index fund provides a broader market exposure as it has all the stocks that are part of that index and in the same percentile proportion. It's in the same percentile proportion, and hence as an investor it gives me a bigger basket of stocks with just one investment. They are open-ended, so I could, as an investor, buy or redeem as per my convenience. It has low operating exposure as these are not very actively traded, and it's a broad buy and hold strategy which is being deployed. The overall cost as well as portfolio turnover are both low. For any investor who wishes to invest in an equity index fund from the mutual fund umbrella, the returns that he or she would broadly get would be the same as that of the index which is being replicated. So if the index gains about 10%, your portfolio would roughly gain by about 10% and vice versa. So if the index falls by about 10%, you may have a fall in this investment of yours by roughly about the same 10%. This investment helps you to have a certain control over the volatility because it is similar to the index and not more. At the same time, in terms of returns, your returns on this investment would be similar to the returns of the index. So investing in index funds can give you controlled volatility, at the same time similar to index returns. That's your first option. The second option available for investing into the passive equity fund options is called exchange traded funds. Just like index funds, ETFs also track a particular index. But under the ETF umbrella, you could also have, commodities. So you could have, let's say, a large cap ETF, or you could have a gold ETF, right? So when you talk of gold ETF, your returns are actually linked to the price of gold and the movement on the price of gold. Okay, and if you have a large cap ETF, your returns are linked to the large cap index that it is being replicated. The big difference between ETFs and index funds is that ETFs are traded on the stock exchange just like any regular stock. Okay, so if I have to purchase an ETF or sell an ETF, I would have to do that on the stock exchange just like a regular stock. Similar benefits like that of an index fund, low cost, replicable volatility, low churn. So that's similar. Just that these are traded on the stock exchange like a regular stock. So I, as an investor, will need to buy an ETF from the stock exchange only. So in terms of, what is going to be the price of my purchase, I don't have to wait for the end of the closing like that. I like when I purchase mutual fund units. Over here, the price of the ETF that I will buy or sell will be the price on the exchange at the time that I decide to buy or sell. So that's the difference. So over here, if I have to buy an ETF, I would have to have a demat account. I would have to buy and sell it like any other stock. It is listed on the stock exchange and it is actively traded from where I could choose to invest in an ETF. Okay. So just to reiterate some of the key benefits that I could derive from investing into passive equity options are: it is low on cost, the operating cost is low, the expense ratio is low, because of which it is low on cost. It is well diversified, it is high on diversified. Over here, you are replicating the entire benchmark. You are not actively choosing which are the securities that you want to trade in, or which are the securities that you think will outperform or do better. It is a complete replica of the benchmark, giving any investor into index funds or ETFs a higher level of diversification. It is easy to implement over here because I am just replicating the benchmark. It becomes easier to replicate. I don't have to bother about which security should I buy or sell. I mean, when I'm saying I over here, I'm talking about the fund management team does not have to bother about which security would they have to buy or sell. So in that sense, it becomes easier to implement. It is tax efficient, as I was telling us a few minutes earlier. Uh, the buy and hold strategy typically does not result in a massive capital gain. And hence, in that sense, it becomes tax efficient. There's also a very high level of transparency, so I'm replicating an index, so I don't have to, and as an investor, I know I am invested into an index ETF or an index fund, and it is a mirror of that benchmark. In that sense, what percentage and what security to buy is something which is as on the benchmark, and that enhances the level of transparency when you invest into any passive equity funds. Moving on to the passive debt fund options which are available, I would like to share with you three options which are there. One is debt index funds, one is fixed maturity plans, and the third is target maturity funds. Let us begin with fixed maturity plans, or FMPs as they are more popularly called. FMPs, as the name suggests, are fixed maturity plans, meaning at the end of the tenure, this scheme will cease to exist. As an investor at the end of the tenure, either I will get my money with whatever earnings that will come out of my investment over here back, or I can choose to invest this into any other scheme of that fund house. Okay, but that scheme is over. It is close-ended, which would mean that the expectation from the investors investing into FMPs is that they would stay up to maturity. You can only invest in FMPs during the NFO period that is there. As the scheme holds papers up to maturity. What this also then does is, in terms of calculating investor I may be earning becomes easier and predictable. So that's another key benefit that I get from FMPs. But in terms of risk, it invests in predominantly banks and corporate papers, and hence, in terms of if the ratings are fine, in terms of what is the portfolio construct that is there, makes them less riskier in terms of investment. Any debt mutual fund scheme in which an investor stays over invested for a period beyond 3 years allows the investor to have what is known as indexation benefits on the capital gains that he or she may earn. And this indexation benefit, helps in reducing the tax burden on your capital gains substantially, and hence that's also a very strong benefit that you would have if you invest in any fixed income scheme, including FMPs. The one thing which, as an investor, you should be cognizant about and keep looking out for if you choose to invest in fixed maturity plans is the credit quality of the portfolio being constructed. If there is even an iota of doubt, or you're not comfortable with the portfolio that is there, my humble request to you would be that you can restrain from investing in this product, because it's a mixture of corporate bonds and bank papers. If I feel that I'm not comfortable in those instruments, then I would suggest that you could stay out of it. Okay, that's fixed maturity plans. The other option that's there is debt index funds. It's just like equity index funds. You also have debt index funds, okay, which track a particular underlying index. The fund holds the same security and for the same maturity as the underlying index. The index usually comprises of government and public sector company bond papers. And hence, due to the government PSU papers which are being held, and these papers carry very, very low probability of default, these index funds become very high in terms of safety of capital. As the index obviously is very clearly known, the level of transparency in debt index funds also goes up. And because you exactly know what's the composition and in what percentage, up to what maturity, and then as a fund management team, I am only replicating it, due to which there is a high level of transparency, which we can see. It is very easy to transact into, and due to it being very high in terms of safety, it also helps you to have a higher level or a higher degree of control over your investment and the risks that your investments may be getting exposed to. That's the second option. The third investment option under the passive investing options on the debt side are target maturity funds. Target maturity funds have been gaining a lot of popularity amongst the fixed income investors in the recent past. These funds generally invest in government securities and highly rated PSU bonds. Okay, making them very high in terms of the safety by reducing their risk of default to almost negligible. Target maturity funds buy these G-Secs and highly rated PSU bonds and hold them up to maturity. As the maturity date is aligned with the maturity dates of the bonds or the G-Secs that are being held, the returns offered by target maturity funds are also fairly predictable and stable. All in all, I would say these funds are very high in terms of safety, low on default, and predictable in terms of the returns that an investor would make. You could use you to invest into these. You could either go through the ETF routes or the fund of fund routes. Both are available through the asset management companies for ease of transaction by any investor, and choice is open for everyone. Target maturity funds are available across maturity. So you would have a fund which is maturing in the coming year, that is 2023. You also have TMFs or target maturity funds maturing in 2032. So depending on me as an investor, what is my investment horizon? I can choose to invest into the target maturity fund which suits my investment horizon. Okay. To sum it up, if I were to share some benefits of the passive debt funds, then I would say better visibility of returns. Most of these are held up to maturity, and hence returns are easily calculable, and hence they become predictable. They offer a very, very stable investor experience. So the interest rate risk due to if the interest rate risk due to volatility on the interest rate sides would be very low, as you're not actively trading papers but holding them up to maturity, making the investor feel more stable and comfortable by investing in any passive debt fund options. The safety is higher, as debt index funds or target maturity funds predominantly invest into government and PSU bonds, which are safer or safer in comparison to other instruments available, rank, and hence the safety factor in passive debt funds, in index and target maturity funds rank higher. Tax efficiency, as I was talking to you earlier too, any investor investing into fixed income schemes over a 3-year period uh, gets indexation benefit over the capital gains. Indexation benefits are usually known to reduce your tax liabilities substantially, and hence passive debt funds also help you in reducing that and become more tax efficient. They don't carry a lot of interest rate risk as they are hold to maturity. And in terms of liquidity, because predominantly in index funds and target maturity funds, you are investing into government and PSU bonds. These papers are more liquid than any other papers in the market. That is, if I want to sell these at any point in time, they would be more easily sold in comparison to any other paper, making these investments highly liquid. So if I were to summarize, to manage volatility in the stock markets, investment options available under the passive equity funds umbrella are index funds and exchange traded funds. To manage interest rate risks and enjoy a higher degree of predictability and safety of my capital and predictability of returns, by investing into schemes holding bonds or papers up to maturity, investment options available to me under the passive debt fund umbrella are debt index funds, fixed maturity plans, and target maturity plans. Next time, whenever you are thinking and planning your investments, I would think that it may not actually be a bad idea to look at these options too. Okay, so this is what I had for all of you guys on this Edelweiss Connect classroom session. I would now like to take your questions and respond to them before we close. Okay, so we have a few questions. The first question is, which ETF should we invest in? Okay, so quite honestly, there are a lot of ETFs which are available in the market. I would suggest that you do your own, risk profiling and have an understanding of how long you want to stay invested in. What is the level of risk that you are ready to expose in? Because even though it's an ETF, it will be volatile linked to the index. So it's something wherein you should be comfortable in. There are a lot of ETFs which you can choose, and basis your risk appetite as well as your investment horizon, I would suggest choose an appropriate one. Okay, so then the next question is, there is an ETF on 2030 and its NAV is changing as per supply and demand. How can I calculate the yield? So what will you get till maturity? Very honestly, so whatever levels you invested into and what you made your calculation then is something which you would get up to maturity. This recent mark-to-market gains or losses that you're seeing is something which is just moving the NAV or the price listed on the of the ETF. Your gains and losses, because the papers are actually being held up to maturity, will not get impacted. You will get whatever you calculated earlier, and that's the return that you would make. So index ETF or index mutual fund, how about tracking error? So there will be tracking error, and that is why when I was speaking of returns, I said roughly close to the return of the index. So there is a bit of tracking error which you can expect. The index composition changes. There is money which I've got. I'm investing that, and there is a traction that will happen over there. So in that sense, there is slight tracking error which can be expected, and that is something which is where I said roughly close to the returns is what you would get. What can go wrong in target maturity funds? So target maturity funds predominantly are government and PSU papers. Uh, you know, can they default? The frank answer is yes, but imagine a government defaulting. I mean, it's going to be a very very challenging situation at that point in time, and looking at the way we as a country are, that probability actually goes very low. Uh, and hence, in terms of what could go wrong in target maturity funds, I don't see anything majorly going wrong if you stay invested up to maturity. Because if you're staying invested up to maturity, the redemption proceeds from the government and PSU bonds would get passed on to you, and you would get those returns, is what I understand. So is return in target maturity funds be the YTM if I hold till maturity? Yes. I mean, if you when you made the investment, whatever was your calculation, your returns will be similar to that. That's how it will work. So what is the tax treatment for investment in target maturity funds or debt index funds? So tax treatment, there are two types of capital gains: short-term capital gain and long-term capital gains. Investment redeemed before completion of 3 years gets subjected to short-term capital gains, which means that capital gains is you pay tax on that as per your tax tab. Over 3 years is something wherein you get what is known as indexation benefit, where there is an indexation CII chart, and basis that you have an understanding of what is the inflation level and cost of money, or how much do you require now to buy similar things. So there's a CII chart, as it's called. Uh, and basis that, you find out what your capital gains are, and then you pay tax on the capital gain basis that indexation. We've usually seen that indexation benefits is something wherein your tax liability drops substantially than your regular as per your tax bracket. So those are the two ways in which you would get taxed in target maturity funds, debt index funds, or even fixed maturity plans. So there is somebody who's asking, my returns that I showed on Nifty are 22% CAGR, but actually it is about 11% CAGR. We could be looking at different timelines, and hence it could be something wherein we have a different chart. But I mean, but that's something which I was just showing as a point. I didn't mean to stress upon it, primarily because what I was trying to say is that passive funds are also uh, giving you returns similar to benchmark. I think let's just stick to that part rather than what has been the return, because if the benchmark performs, passive funds will perform. If benchmark falls, passive funds will fall. Okay. Are index funds algorithmically managed or human intervention is involved? It's both. There is obviously a replication, and whenever money comes in, the system picks it up and replicates the money into the entire index. But obviously there will always be a human oversight looking at it. Okay, so great questions, and thank you very much to all of you who put in the effort, not only for the questions but also to take your time out on this Wednesday evening and spend that time with us. I mean, we would also be releasing short videos on passive investing on our social media platforms. So it may actually not be a bad idea for you to follow us over there too, as these would also then keep on enhancing whatever we spoke about today, and help you in enhancing your understanding further and making decisions with a little more knowledge in terms of the investment choices available under the passive world. Great. So thank you very much for your time. As usual, it was a pleasure. And we look forward to connecting with you again on another interesting Edelweiss Connect classroom session soon. Till such time, do take care of yourself and please do stay safe. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.